welcome back to my channel, Trading Secrets. This channel is for entertainment purposes only, and I am not a financial advisor. So for those of you who do not know, my name is Ali. I have over 20 years experience teaching accounting, economics, business and law. So through this channel, I would like to provide some stock analysis and at the end of each video, a short trading lesson for 5 minutes to improve your trading skills by helping you increase your knowledge, reduce your risk and improve your strategy. So please stay tuned till the end. And for those of you who do not have currently a Trading 212 account, please help to support this channel by using the link to get a free share with your first investment, and that will also help me as I will also receive a free share. So without further ado, let's start with the first stock analysis. Okay, so quick recap on the previous stock analysis that I carried out. First one was ticker symbol ATOS and the other one was ticker symbol AMLM. So please refer back to the previous video for full analysis of those two stocks. First stock I'd like to make a start off by looking at today is ticker symbol APXT Apex Technology. Previous day's trading, this closed at 3.5% down, closing at $14.88. Across the week, it was down 4.68% and just over 4% down on the previous month. So let's have a look at the chart for APXT. So if we look at the chart for APXT, we can see December 2020, it was closing just close to $17, and then there was a little bit of a sell-off, consolidating around about just over $13, and then a little bit of movement up again. Resistance point at around about $15, and if we go all the way to present, just the start of February, we can see right now the general movement down was a peak close to $17 in January, mid-January, and now it seems to be consolidating a new resistance of just around about under $15. So this puts us as new investors or reinvestors as a good position and a good potential entry point. So let's have a look at why is there an interest in APXT and why should you consider this as a potential investment. So APXT is not actually a company generating any revenue. It's a company which has blank check company for the purposes of a merger. So what we're more interested in is who is this merger with and what is the potential. So let's have a look at the company in question. Company in question is Avepoint. So if we have a look at Avepoint, so what I have on the screen there is a summary of Avepoint and their track record of product development and innovation, and the blue line also indicates change in revenue. We can see the general trend is upwards. So it was first obviously founded in 2001, and in the early days they're an IT solutions company, and they have developed platforms at the beginning 2001, 2002, 2003 SharePoint platforms, and then as we can see the innovation has continued. We're looking at all the way down to present. As investors right now, we can see what are we interested in now, what's the potential in 2021. So if you refer back to the latest insight into the company, 2020, right at the top right of the curve, we can see that they have a partnership agreement so far with Microsoft in providing policies and insights for the Microsoft 365 My Hub. So this is very, very positive. This gives the company great potential in terms of Avepoint. So the merger is going to take place very, very soon. It's imminent within the next 2 to 3 months. So we're going to have a now look at an overall analysis. So let's have a look at an overall analysis now. So APXT, the current market cap is 646 million, so not huge. Post-merger, APXT will own approximately 17.6% of the combined company. The valuation of Avepoint is just about $3.67 billion. So if we look at those figures, 17.6% of 3.67 billion is going to be much, much more than the current valuation of APXT. So as investors, this is positive. Avepoint is also the largest independent software vendor of SaaS solutions to migrate, manage, and protect data in Microsoft 365, which we just looked at there. And as investors, right now the merger date has not been announced, so which could be represent a good opportunity to enter this stock before the spike. So the merger date has not been announced. I don't think the merger will take place in February 2021. However, there could be an announcement in February of a specific merger date, which is most likely going to be in March 2021. Again, no announcement. So currently we can see there is consolidation. It could be a good time to invest. And going forward, post-merger, valuation of APXT will certainly increase, and this has potential to at least 2 or 3x within the next 2 to 3 years after merger. So certainly want to put on your watch list. And to finish off, a good entry point for APXT to make your first strike in this. I would suggest, as it has been consolidating, it is a good time to buy under $15. But if you see this stock at less than $14.50, this would be a good opportunity to make your strike. So $14.50, if you see this at anywhere close to $14.50, and then consider holding this for at least the medium term. Okay, now let's move on to the next stock analysis. Okay, next stock analysis is for ticker symbol XL. So this company is known as XL Fleet. So let's have a quick look at the company profile. So we can see here they develop and deploy electric hybrid solutions for the commercial municipal market in North America. So this includes hybrid electric drive systems. We're also looking at performance indicators such as miles per gallon, so an increase in performance from a point of view miles per gallon. And this company also aims to reduce carbon dioxide emissions. The focus is more on the commercial vehicles, such as if we have a look on here, so commercial vehicles such as pickup trucks, cargo, passenger vans, commercial vans, box trucks, delivery vans. And it focuses solutions for Ford, Chevrolet, GMC, and Isuzu. So let's look at the share price. Previous day trading, it closed at $18.99 across the week. This was 0.52% down across the week. It was just over 9% down across the month, 22% down, and over 3 months, XL Fleet has increased by over 89%. The peak in the share price was just over $32 on the 22nd of December 2020. So this now represents possibly a good entry point for an investment here in XL Fleet. It could be the right time now for a movement up. So let's have a look at a potential entry point for XL Fleet. So for XL Fleet, potential entry point, I would suggest anything below $17 would be a very good entry point. So if you consider a strike price just over $16.50 and below $17, that would be a good strike price. Let's also have a look at the company website. So if we have a look at the company website, we can see XL Fleet, 3 aspects to their business. So they have fleet ready electrification solutions. So 3 aspects of the business. We have the XL Hybrid, the XL Plug-in, and the XL Link. So the potential in this business is, at the moment, it's more to do with commercial vehicles. If this kind of technology can be moved over to non-commercial vehicles, then the potential is huge. So XL Hybrid, this delivers a 25% increase in miles per gallon and 20% reduction in the CO2 emissions for Class 2 to 6 fleets, and it's available on their OEM platforms, including Ford, Chevrolet, GM, and Isuzu. So the XL plug-in solution is available on the Ford F-150, F-250 pickup trucks, delivering an impressive 50% miles per gallon increase and a 33% reduction in the CO2 emissions. So that's also positive. And finally, on their website, we can see there they have the X link, which provides actionable intelligence on their vehicle electrification metrics and emissions reduction summaries, and it alerts the service team if there is an issue. So that's also positive. So XL fleet, ticker symbol XL. So this is also good stock to put on your watch list. And now it's time for the lesson of the day. Okay, so let's have a look at the recap of the previous lesson. So previous lesson we looked at horizontal integration, vertical integration and diversification. We looked at increasing our knowledge of these key terms and what it means for the share price. So today we're going to look at common mistakes by investors. So let's have a look at some of these. So if you refer to the screen, one mistake is only buying hype stocks. For example, many people will just invest only in Tesla. And if you refer back to one of my earlier videos, I talked about the importance of diversification to protect your investments. So this can help limit your losses. It's a bit like saying do not put all your eggs in one basket. The other mistake common is selling on the first drop. If you refer back to my lesson on looking at stop sell limits, we can see that to achieve a higher return, you have to allow for the downs to achieve the increase in share price, because the share price is not going to just go one way. It has to go down, up, down. It cannot go continuously in one direction. Mistaking trading with investment, trying to time the market. There is no fixed time. Overcomplicating things. It's not complicated science. It is much more simple. Failing to diversify, which we just talked about. Another thing I don't agree with is copying somebody else's portfolio. I do think this is not good strategy. The reason why it's not good strategy is making an investment in shares is more also about the entry and exit points, and by copying another person's stock picks, it's almost impossible to copy the exact entry point, because you would have to know at the right second, at the right minute, and that's not possible. You're not, just because the share price does not remain fixed. So copying another person's investments or another person's stocks is not always good, because it's about buying at the right price, and that is not possible just by copying them. So buying based on dividend yield, it's not a good idea. You must diversify, look at a range of different companies, not companies that are just going to give you a dividend. It's not always a good idea just to look at the shares and stocks with small or low PE ratios. That's not always a good indication. Sometimes a company could have a new patent, new invention, new idea, and something that is growing fast. So it's also to do with the potential, not necessarily the PE ratio. Paying expensive fees. So trading is much cheaper now. It can be done on your phone. You don't necessarily need brokers. And I personally use the Trading 212 app, which is also zero fees. So consider using that as well. There is a link on my description for anybody who hasn't started investing using that app, and you will receive a free share. Also, not a good idea to invest just on margin, and investing based on emotions is also not a good idea. Refer back to my previous lesson on FOMO. Okay, so these are just some common mistakes by investors. I hope you enjoyed the video today, so please stay tuned. Like, subscribe, and join me again in the next video.